Good morning, everyone. We may as well make a start. We're just after 9 o'clock. Hopefully, everyone can see me and hear me okay. For those of you who don't know who I am, my name's Gordon Richards. I'm one of the directors in charge of our business services division here in Perth. Work in various different or with different clients in all different aspects of business, largely around the commercial space. And here today we're going to be chatting about all things cash flow. There's a fair bit in it, and obviously some of it is a little bit specific to certain types of industries. So, some things you might be able to do and some things you may not be able to do. But hopefully you manage to pick a few things up and just look at the things that we look at and that we talk to clients about as well. So I will start the presentation in a sec, but please, if you do have any concerns or any issues with the slides, I think Shane's online as well, so you can touch base with her. And if you do have any queries, just pop them in the chat box. I think there's a little box down the bottom of the screen just with chat options, and I will keep an eye on it, or try to keep an eye on it, and answer them as I go as well. So hopefully you get a few things out of it and improve your cash flow. So I'll just share my screen now, so bear with me. Cool. So hopefully everyone sees that okay. The normal disclaimer. So I suppose what we're going to touch on today is all things cash flow. So those are a few points that we'll run through. So where does your cash go? How is it used in business? What working capital is and what you need to think about with working capital. We will touch on a few things around cash flow budgeting, which I think is vital, particularly for any new business, and it's something that is not done often enough. We'll go through and talk about different options to help cash flow. So some things that you guys can hopefully adopt and which will improve cash flow and conserve it, I suppose. We will touch on some finance options and which obviously something else that you can do to ease cash flow or to aid cash flow. And then the age-old question that we get multiple times a year is cash versus credit. Should I borrow to buy an asset or just use the cash in the bank? One of the most common questions we get at work. So we'll touch on that as well. So I suppose first of all is where does your profit go? So again, another common question that we get, particularly when we're around end of year. We've done the financial statements and are having a discussion with clients around how they went, and we might say, well, the business has made $100,000 profit for the year. A lot of the time, the first question or first point that's raised is, well, I don't have that in the bank. Where's it gone? And it's a very easy response, I suppose, and it's a very easy question to ask as well, I suppose. So profit, as I'm sure a lot of people know, doesn't always convert to cash, and cash doesn't always equal profit. There are a number of things that are included in a business and in your financial statements that aren't reflected on your profit and loss. So those 5 things there are pretty much the main areas, or there are the main areas where all your cash goes. So working the way through it, working capital, and we've got a section on that in the next couple of slides. But that's debtors, creditors, immediate cash assets versus immediate cash liabilities, basically. So it's the day-to-day running of the business and the day-to-day capital used in the business, basically. Owner's drawings, again, the amount of conversations I've had with clients saying, well, you made $150,000 profit, but you're struggling to meet your debts, you're struggling to pay the ATO, but their drawings are sky high. And that's okay. That's a personal choice. We can't influence that, but yeah, and everyone's got personal obligations and things. But a lot of the time, where people are struggling with cash flow in the business, it's often because they've got obligations outside of the business that require that cash flow. Loan repayments, yeah, financing, equipment loans, ATO loans, which covers on that next one in terms of tax. But as you paying off debt, that's a cash drain on the business. Tax, self-explanatory, tax is tax, and we've all got to pay the tax man, whether it's GST, pay-as-you-go withholding, or income tax. Yeah, that is ultimately where cash goes, and then equipment purchases as well. So, yeah, buying assets, which is often linked with the loan repayments if you're financing it. But if you need to reinvest those profits, that is something there where you might see your profit as a figure, but it's all being reinvested into equipment purchases and the likes. So on that first box, working capital. So I suppose a lot of times people don't quite understand the concept of working capital, and working capital and sort of liquidity of the business go hand in hand, or it's often a similar sort of factor, similar item. So working capital is the money of a business, which is used in its day-to-day operations. So it's calculated as your short-term assets less your short-term liabilities. So the easiest way to explain it is you make a sale, and this is assuming you're on accruals and you offer credit and the like. So in other words, you recognize debtors and creditors. You make a sale of 10 grand, and you incur 5 grand of costs to make that sale. You've got 10 grand of a debtor, and 5 grand of a creditor. So there's 5 grand there net cash, but as we know, it's not necessarily cash itself, because people still need to pay you need to pay your suppliers and so on. So that concept of the ins and outs and day-to-day stuff and mixed with debtors, creditors, and cash is tied up in working capital. So it's obviously, if some businesses have high working capital requirements, because there's big short-term cash outlays and so on, whereas others don't need so much working capital. So it's really it's the almost immediate cash requirements of a business. Is there enough cash in the bank to cover short-term debt? So X months worth of wages, rent, BAS payments, those sorts of other liabilities, basically. Okay, and those last 2 points there, particularly the last one, ability to meet your short-term debts as and when they fall due, is the definition of liquidity. Okay, so they do fall hand in hand, working capital and liquidity. And I think when trying to assess your working capital or your cash flow requirements of a business, so working out what cash you need day to day and where you're going to get it from, assessing your working capital is vital, and particularly in a new business. If you're starting out a business and you're not sure on how things are going to go, trying to work out what working capital is that you need is vital, because it may mean that you need to borrow a bit more from the bank to start up, so that you can fund things until you get a bit of a war chest as such, piggy bank to back the business up, basically. Okay. On a few ratios, and again, I sound like a bit of a boring accountant talking about ratios and things, but it's all about just looking at the figures, trying to work out, are you doing okay in the business, and are things tracking okay? A lot of the time you'll probably feel it before the ratios kick in, so you'll feel the cash flow squeeze before these start to show that. But these four are probably, in terms of working capital and liquidity, these four ratios are the most common and most effective that we look at. So the first one is liquidity ratio, which is current assets divided by current liabilities. And that just shows how liquid your business is. It shows what sort of short-term assets you've got compared to your short-term liabilities. So anything between 1 and 2 is desirable. So if you've got $100 in the bank and you've got $50 worth of creditors, your liquidity ratio is 2. And so that's fine, because you've got more money in or coming in to meet the money that you've got going out or about to go out. If it gets under 1, it means that there's likely a cash squeeze, and it's going to be hard to meet your upcoming debts. There are some businesses that manage to keep going and just run with a very low liquidity ratio. Transport companies are one, for example, where they've got high immediate financing requirements. So they've got lots of loans for truck purchases and trailer purchases and things. They tend to have a very low liquidity ratio, but they just manage their cash flow day to day and seem to cope with it. But just assessing that current assets versus current liabilities is vital. If it gets too high, so in other words, if you've got a liquidity ratio north of 2, it's not a problem, it's a good thing, but it means that you're possibly a bit conservative, and which is fine. You just keep more money in the bank as a war chest nest egg. But there's also thought there that if your liquidity ratio is too high, can you be using those assets for something else? So can you invest in something else, whether it's in another asset, a fixed asset, or business growth, or something to that effect, basically. So you do have if it's too high, the thought or the mindset is, can you do something else with that money? Inventory days is very specific to retail. As I said at the start, this may not be relevant. Well, it's retail or any type of business that carries stock. So whether you're in parts supply or things like that. Obviously, if you're like a contractor, that won't be relevant. But it's really the amount of days that it takes you to turn over your stock. So if you've got X amount of stock on the shelves, how long does it take you to sell that stock and convert it into cash / debtors? I suppose generally in this presentation, apologies, I should have mentioned this in the start. If I sort of refer cash, it's not necessarily physical cash, it's cash at bank, cash and debtors, basically. So your debtors are generally referred to as cash for this presentation. So inventory days, how long does it take you to turn your stock into that cash or debtors? Okay. And if it's too long, it means that your stock is sitting on your shelves for too long and it's not turning over, which means that it's a dead asset. It just sits there and doesn't convert to cash, which then enables you to pay your liabilities. Okay, so if you are in parts or retail, just looking at your stock and looking at those inventory days and seeing how quickly you turn it over will impact or will help with cash flow generally. Debtor days and creditor days. So obviously debtor takes into account the sales side of things and creditors are the purchases. Really, it's how long does it take your debtors to pay, or how long it takes you to pay your creditors. So you want debtor days to be as short as possible, whereas you want creditor days to be as long as possible, within credit terms, obviously. So yeah, the longer your debtor days are, the longer it's taking your clients to pay you, which then obviously has a drain on your cash flow. It's generally calculated by debtors divided by your total sales or your forecast sales, times 365. So if you've got credit terms of say 14 days, but your debtor days are 50, 60 days, obviously it means that your clients are taking a lot longer to pay you outside of your normal credit terms. Okay, and creditor days are similar, but it's on your side. So you want to push creditor days out as long as you can, whilst keeping your creditors happy, because otherwise they'll be hounding you for cash. Cash flow budgeting it's vital. I think, as I said at the start, it's probably one thing that is underdone in most businesses. Most businesses just tend to just sell things and pay for it, and don't think about how their cash flow is impacted. It's not, running a business isn't just income and expenses, it's the timing of those as well. And so when you're starting out a new business, or when there's a change in your business, whether it's a downturn or a flattening of the industry or significant expansion, you need to budget cash flows. As I said at the start, your profit goes into various different aspects of the business. So you may be profitable, but your cash is used elsewhere. So just trying to forecast what is coming in and what's going out is vital. One of the most common ways that I've seen over the years where businesses fail is they're doing really well and are growing and growing really well, but cash flow, it hits them. So, prime example is you doing really well, you're winning all these new contracts and big contracts. You stock up on equipment and reinvest in equipment, and you buy all this gear and borrow for it, which is needed and is useful, and get all these employees on that, and then cash flow hits a cliff. Cash flow stalls because you've got all this outgoings happening in terms of paying your equipment loans, paying your employees, and all the cash is leaving the bank. Yes, you're making sales and they're coming in, but they're coming in slower than what you may have initially envisaged. And all the cash is going out, and it just, it reaches a turning point or an end point, and that's where businesses go bust. Okay, so it just gives you the plan to predict, or the ability to predict and plan for, what's coming up. When is your money coming in, and when is it going out? So I'll just share an example. So I've got two. This is a very high level one, where it's basically month by month, and it can literally be as simple as this, where you go month by month, forecast, you've got an opening bank balance, you forecast what money is coming in, whether it's customer payments, income, or bank interest, and what's going out, and the timing of it, to work out what and there's your profit. So that's effectively your cash profit as such, as opposed to accruals profit. And then you've got other payments. So money you're getting back into the business, whether it's from banks or owners' advances, and other money going out, loan repayments, BAS payments, drawings, tax payments, and so on. And so you can see you've got your net cash flow there, which shows, July you're down, August you're up, September you're down, and so on. And so you're looking at your closing bank balance, and you think, okay, well, yeah, October, after I pay my $90,000 VAS, I've got a problem. So I'm going to be 20 grand short. What do I do? Come February, after I pay my December VAS, again, problems there. And we're up to 108 grand short. So what do we do? So as opposed to rather than figuring that out there, you're figuring it out, or you at least close to figuring it out, there. And so a few months ahead, so you can plan for it and say, well, we're going to be tight in Feb, March. What do we do? So that's, just even something as basic as that is very, very handy. You can go next level, and you basically do this is a three-way forecast. So and again, this is just the template that we use. So it starts at very, very broad, but you can see it's done weekly. And some of the bigger businesses that I've worked with that have had cash flow issues do it weekly. So they literally go through their entire debtor list and say, okay, Joe Bloggs, we expect him to pay, or rather his invoice is due next week, but he's always late, so we'll forecast that coming in 2 weeks' time. And you actually go week by week and say, what money are you expecting to come in, and what money are you expecting to go out? Okay, and then that, you chop and change and tweak it, and at least you may only look 1 month in advance, but at least you've got that month to recognize that something is going to happen. Okay, and that just, that planning aspect is vital, because if you don't, things will dry out, pretty quickly. So I did have a break-even example here. So break-even, whilst it's not cash flow related, it's still important. So break-even is the point at which your sales exceed your expenses. So in other words, to break even, you're making nil profit and you're not making any loss. So and again, this is one that's more geared towards like fixed and variable type business. So as an example, a manufacturing business, if you're manufacturing X amount of sales, or X amount of products, your actual material cost and your direct wages are going to be dependent on what that sales figure says. So it's looking at what variable costs you've got compared to what fixed costs you've got, which fixed is rent. Rent doesn't change if your sales go up. And just trying to work out that break-even point obviously helps profitability, and it does link to cash flow a little bit. So whilst this is not specifically cash flow related, it's always important to think about as well. Okay. So just plan ahead basically. If you don't plan ahead, you're not going to see that hole in your cash flow, which means that you're not going to be able to do anything about it. Okay, and doing things and what you can do, and we'll go through in a second. So options to help cash flow, and again, not all of these are relevant, or could be relevant to your business, because they, as I said, some businesses are different to others, whether it's retail or contracting or different. So as I said, hopefully you can pick up a couple of points from this, but it may not all apply to you. Okay, so this is a bit of a list that will help cash inflows, so help money coming into the business, and then we'll touch on cash outflows in a second as well. So FPOS, cash payments, cash on delivery, cash up front, even half up front and half once the job's done. the quicker you can get cash in the door, the better. So, you know, a lot of the times you see businesses, whether it's tradies or things like that, is say, oh yeah, no, you sort it out when you can. That comes in and bites them a lot of the time. Whereas other times you get tradies who bring an FPOS machine with them to the job, and so as soon as they've finished doing the job, they'll give you the FPOS machine. You've got to pay there then and there. So encouraging that upfront payment just means you get the money into your bank account quicker. And it also, and we'll sort of touch on this a bit later, it also helps or minimizes the possibility of bad debts and people not paying you. Okay, so try and get cash upfront as much as you can. Okay. Establish a credit policy. So who are you going to offer credit to? What limit are you going to offer to people? And how long do they need to be customers of yours before you offer limit? Do you have different scales for different types of customers and different different length that they've been a customer? Or if they buy more from you, are you going to increase their credit limits? So just having some guideline around who you give credit to and what the terms and conditions of that credit is. Okay. Again, the amount of stories where you hear people, you know, set a credit policy to start with and say we're only going to let people borrow or rack up 10 grand worth of invoices on their credit, but they've got no terms and conditions around it. There's no guidelines as to what happens once they go over the due date and so on. And a lot of the time it falls, or establishing a good credit policy falls into this last point here, knowing your customers. So, don't offer a $50,000 worth of credit to Joe Bloggs who walks in the door and comes to see you for the first time ever. Get to know them first, know who they are, know where they're getting their income from, and then establish credit around it. So, just planning it all basically. Making invoices clear to facilitate payment. Again, don't put your bank details in tiny little font right at the bottom of the invoice where no one can see it. Make it bold and in your face so people can see where to pay and how to pay. A lot of the time, bookkeeping packages, whether it's Mile or Xero or whatever you use, do offer direct payments. Like they do charge for it. Your subscription fees will go up, but a lot of the time they'll have a link on or offer a link on your spreadsheet where on your invoice where a client can click it and say pay now, and it just automatically takes them to pay it with a credit card. Just thinking of different ways in which you can collect your payment quicker, and whether it's just EFT or BPay or credit card online or whatever it is, just trying to facilitate that payment will mean that the money comes in quicker and will mean that you get paid, that your cash flow aids or helps it. So, invoice earlier. Don't wait for weeks and weeks and weeks before you invoice a job. Again, personal experience where you'll get a tradie that comes and does a job for you, and you wait 3 weeks before you get an invoice from them. Great for me as a payer, because it's 3 weeks more in my pocket than theirs, but from their side of things, it will impact their cash flow, because the quicker you invoice, the quicker you'll get paid. And again, if you're doing bigger projects, rather than waiting until the end of the project, invoice on milestones. Again, you need to discuss that with your client, but invoice along the way in components as opposed to one big lump sum at the end. Because if you do invoice right at the end, you're incurring, say it's a 6-month project, you're incurring all of those costs for those 6 months. So before you receive a cent in your bank. So your working capital and your capital backing needs to be huge to cover those 6 months worth of costs. So invoice through different milestones of the project, and it'll help cash flow. Reduce time to receive payments. I sort of touched on that. For more payment options, online, BPay, credit card, those sorts of things. Early payment discounts. Look, that's a tricky one. Will you offer X amount discount if someone pays you early? I think you should only really be doing that if you've got decent margins built into your sales figures. So if a job is going to cost you X dollars and your margin is big, then you can probably afford to cut some of that back if someone pays you quicker. I'll be honest, I don't personally like that option. I think you should be paid for what you do, and it should be set, but it is an option. Monitor debt collection. Actually look at who owes you money and have a policy, have a system of follow-up. So, do they get an email one day after the invoice is due, and then a week later they get another email, a more sternly worded email, and then 2 weeks afterwards they get a phone call. Just having that policy so you know when to chase invoices up and how it happens and what happens rather, just aids that throughput of cash. Follow up overdue accounts. That's just what I said. It's understand it's tricky. We're all busy, and you're busy trying to do the actual core work of your job as opposed to chase up people who owe you money. But if you've got cash flow issues, you should be doing that. Okay? And then know your customers we've talked about. On the cash outflow side of things, and again, like a lot of the time, it's often beyond your control. You need to keep your clients, not your clients, your suppliers happy, and so you don't have a choice in it really. But these are a few things where they can possibly help you or at least ease the pain. Okay. Making payments only when they are due. So again, going back to the creditor day side of things, don't pay an invoice the date that you receive it. If your supplier offers you 14 days to pay it, take that 14 days. Okay, because that's 14 days that you can use that money, as opposed to them using it basically. So just only pay it when they're due. Okay. If you've got a key, and I think this is down there, that's the next point. Prioritizing suppliers, keeping suppliers that are critical to operations happy. I shouldn't say this, but pay your parts supplier, your material supplier, before you pay the ATO. So you've got to manage it and keep everyone happy that you can. But if things get really tight and are difficult, you need to go through and prioritize the suppliers that you rely on to keep operations going. Okay. Check invoices. Again, a lot of the time you might get an invoice from your supplier, and you just and you just pay it, and there's an error on it, which does happen. It's probably less so these days with the more advanced invoicing systems and things, but just check it and make sure that what you're paying for is correct. If you pay it and then you've got to try and chase it up and get that money back, or you've got to keep that as a credit for a future invoice, it just drains cash flow. Okay, so just check your invoices. Negotiate extended credit terms, and I suppose credit terms generally. Just the longer you can push out payment, the better. So if you can get an extra week to pay your invoices, the better. Credit terms generally, you've just got to be a little bit careful with, and it's not just around pure cash flow. I had an example a couple of months ago where we did a restructure for a client, so they were trading normally through a trust, they got, call it 50 grand worth of credit, and that which they had for a long time. They'd had for 10 years and had never been late. We did the restructure and changed it to a company, which meant that we had to renegotiate the credit or reestablish the credit with the supplier. And as I said, they'd been doing it for 10 years, hadn't been late once, had 50 grand worth of credit for 20 years, or say for 8 of those 10 years. But when we did the restructure, the supplier had changed their policy in relation to credit, and the limit had now reduced. The maximum limit had reduced from 50 grand down to 10 grand. So, my clients there that was used to being able to rack up 50 grand worth of credit, whereas now it's down to 10, which meant he had to pay it more often, which impacted his cash flow. Okay, so just all things credit, just make sure you consider it and think about it before you change anything, and try and push it out as long as you can. Okay. Again, on the flip side, we talked about offering early payment discounts, whether you consider taking early payment discounts. So is it going to cost you less if you pay a week earlier? Again, I'm not a massive fan of it, but if you want to get that benefit and you've got the cash flow that allows for it, so in other words, your cash flow budget that you've done says you've got excess cash and you can take that early payment or make that early payment, then consider it. Ongoing discussions with creditors. Again, if you're struggling to pay a creditor, and you stick your head in the sand and don't do anything about it and don't pay them, they're going to be a lot grumpier and a lot nastier than if you turn to them and say, look, I'm just in the cash hole at the moment. Give me a week and I'll pay it to you. And you're open with them and upfront. It's not going to stop that cash outflow, but it's just going to ease the pain. Okay. Seek alternate supply options. Go explore different options. You may have one supplier that only offers you 2 grand worth of credit, whereas another offers you 10 grand. I wouldn't recommend credit shopping. So don't rack up credit on this supplier and then go to that supplier and rack up credit there, and this supplier and rack up credit. Whether it's a supplier or credit card or anything like that, don't credit shop, because that is bound to end badly. But just look at options. Okay. And then discounts for bulk purchases. Again, it's similar to that early payment discounts, but if you buy X amount more, are they going to give you a discount? Again, look at your budget to make sure that you've got the ability to pay that increased amount. And also going back to like our inventory turnover, make sure that if you are stocking up on stuff, it's actually going to be used within a short amount of time. Okay, because if it's not, which is our next slide, it's just going to be tied up in stock. Okay, so stock control. As I said, this slide's very relevant for retail parts suppliers, anyone that's sort of buying and selling stock. It's still relevant where you need, whatever you're doing needs a bit of stock or materials, so needs a backing of it. I've got a cabinet maker, for example, he sort of manufactures flat packs cabinetry. So he goes through a lot of laminate board, your MDF board, or your hardware, so your hinges or door handles or things like that. He uses that a lot day to day. So he's not in the business of selling it, but he needs it. So, and these few points are very relevant for a business that deals in stock or needs materials to do what it's doing. Okay, whereas not so relevant for a contractor or an electrician or something like that. Okay. But if you are in that game, calculate your gross profit margin. So, gross profit is it's the core profit on each item sold. So if you are making a flat pack desk, what is your input cost? So how much does it cost you to make it compared to what you're selling it for. Okay, because if your gross profit is not there and is not sufficient, it's never going to cover your fixed profit. I mean, your fixed costs rather. Okay, so just assess that. Look at your profit margins. Have you calculated them right? Are you selling enough to warrant the fixed costs that you've got? Okay. Pricing, increase or review your prices. Again, over the years, I've had plenty of discussions with clients where you sort of say to them, I think your pricing is not quite where it needs to be. So in other words, you've looked at your profit margins and they're not quite there. They might be 10% under or whatever it is, and you say, well, let's increase prices. Often the response that you get is, oh, no, I don't want to do that because I'll lose too many customers, because they'll shop around and find something cheaper. A lot of the time, and you've got to look at this and you've got to assess it and assess the risk on it, but a lot of the time, by increasing prices, you will have more upside than you will downside. So in other words, yes, you may lose a few customers, but what you benefit from increasing your price will outweigh what you lose in customers that go somewhere else. Okay, so just consider it. Don't compete on prices. Again, if you're tendering for a job and you're keen to win it, don't cut your margins back, because it will come back and bite you. So, if you're going in pretty skinny on a job and tendering right on the limit, something goes wrong and you don't have the cash flow to support that, you will struggle. Okay. Cash discounts we've sort of talked about already. If you do get discounts for paying up front, consider it. Prevent theft. It's easier said than done often, but yeah, just look at that. Verify supplier bills, inventory systems. As I said, stock control. When you're very reliant on stock, so in other words, you've got a big working capital requirement because a lot of your cash is tied up in stock. Making sure that your stock levels are right, only ordering new stock as and when you need it, things like that are vital. Otherwise, stock is dead money basically. It just sits. Same with that last point. Don't carry outdated stock. If you've got outdated stock, discount it and get rid of it. Just because it's just whatever anything you get in, say it's normally $100 and you decide to sell it for $50, at least that's $50 in your bank as opposed to sitting on the shelves doing nothing. Okay, so just that stock control in a business that has high levels of stock requirements is vital. A few other things. And this, to be honest, this slide is really what you need to do is, if you are struggling and things are tight, literally go line by line through your P&L and say, okay, well, we're paying this in rent costs. What can we do? Go to your landlord and say, look, what are our options? Can you give us slightly lower rent, or can you give us longer to pay? Calling your bank and say, look, we're paying you a chunk of interest. Can we drop it? Look at refinancing. Again, prepayment of expenses, just timing of cash flow. Non-essential outlays. Again, excessive drawings. You've got obligations personally. We all know that. But if your business is struggling and is teetering, taking excessive cash to buy whatever it is that you don't really need is potentially going to save your business in the long term. So just thinking about that. Leasing of assets or hire purchase as opposed to purchasing outright. We'll touch about that in one of the later slides. But yeah, thinking about timing of cash outflows and equipment purchases. Yeah, just look at that. staffing and part-time staff as opposed to full-time staff or casual, and staffing levels generally. Yeah, just again, it's a cash outflow. Paying wages and super and things is a cash outflow. Again, another example, had a client that he found that his staff they were getting heaps of overtime coming through. So the staff were sticking around and their timesheets came on and their overtime was constantly well above where they needed it to be. We discussed it with him. He actually went out and had a look at what his staff were doing, and staff, and this tends to happen with younger staff generally, but the guys were, sitting around the workshop chatting or sweeping or doing non-vital things, and they were just there because they had nothing else to be doing, and they might have been doing bits of work, but it wasn't vital overtime. Like, it's not that they were there meeting deadlines. So he set a cap of the overtime, and once they reached their cap, they needed to get approval to stay longer, and that cost just immediately dropped. So it's just monitoring what staff are doing, who's working, what levels they're working on, and so on. So credit checks on clients, again, going back to that, know your customer, do the homework before you offer it to offer credit. There's credit agencies that help with that, and can do background checks and things, and it's important, because if you've got a client that's coming and asking you for credit and they are credit shopping, so in other words, they've got debt here, there, and everywhere, and are have defaulted in the past, that's going to show on their credit history. So just do your homework, check it all. Okay. And then again, checking utility providers and asking for discounts. Yeah, standard. So it's just assessing options. So just on finance generally, so yeah, finance is and there's lots of different types of finance, which I'll go through in a sec, but it's always a bit for clients that are used to being not having any finance or going into business for the first time. It's always a bit daunting, knowing that you're borrowing X amount of money to X amount of dollars rather to start the business. But a lot of the time it's a necessary evil. Okay, so whether that's an established business that's looking to buy a new asset or expand or grow, or it's a brand new person that's looking to buy their first machine to start business. It is daunting, but again, it comes down to the cash flow side of things. Rather borrow money and pay it off over a period of time. Yes, it's going to cost you extra in interest, but having that money in the bank is vital, and having time to pay it off will just aid cash flow. Okay. Different types of finance available. A lot of them are self-explanatory. An overdraft. How much can you take out of your bank more than what's in there? They often, a lot of these loans, like particularly an overdraft and a short-term loan, for example, come with a higher interest rate. So you just got to plan around that. But someone that doesn't have fixed security to take out a long-term loan, for example, they're sort of stuck in that they should only have an overdraft, or they will have to go into an overdraft or a short-term loan. So yeah, overdraft is just a bank arrangement. It's just a bank account, really. Long-term loan, it is what it is. Borrowing money against your house, securing against your house, and having 20 years to repay it is a great option, but you need to consider everything around it. The more emergency short-term loans, again, because they are emergency and a short-term and a last minute, and often come as low doc loans. So in other words, you don't need to give the bank everything, including the kitchen sink. They'll just look at your P&L and give you the money. They come with hooks, basically. So you get a lot of different short-term lenders, where they're just gone blank on who they are. But they will often hit you with, like, I've seen some as high as 35% interest. So you get the money short term, but you're paying the cost for it. So just be cautious with those short term loans. But sometimes you're stuck and you have to do it. Okay. Equipment finance, and we'll talk about that in a sec. But yeah, borrowing money to buy equipment. And again, just think about it and look at the terms and conditions of them. You know, a lot of the time we get questions from clients saying, "Oh, I've got a bit of extra cash. You know, should I put it off and pay my equipment loans out?" A lot of the time, those equipment loans are fixed interest. Okay, which basically means you pay the same amount of interest on the total loan if you pay it today as opposed to in 3 years' time. Like, obviously, if you pay it today, you're paying it all up front as opposed to paying it off over 3 years. So, you know, you've just got to be mindful of what the terms of those equipment finances, and making sure that you don't pay it now when you don't have to. So in other words, if you pay it now, you're not going to save any different to paying it off over 3 years. So just being mindful of that. Credit cards, yeah, self-explanatory. The other one that's not on there, which is more and more common, is debtor finance. So what debtor finance is a bank will come in and look at your debtor book, so who owes you money, and they will lend you money against that. Okay, so if you've got 50 grand owing to you from Rio Tinto, that's only due in 60 days time, they will give you the money now. Okay, and then when Rio Tinto pay you in 60 days, the bank takes that money. So they pay you up front rather than having to wait until that debtor pays. As I said, it's more and more common. It is hard to get out of. Okay, so once you're in it, it's great because you get payment up front. So in other words, I think you've gone blank on the exact terms, and they're all different, but you might issue an invoice and you'll get paid a week later. But once you're in it, it's very hard to get out of it, because you basically, I need to do this right in my head, but you basically need to wait like double the amount of time to get out, and trying to get out of debtor finance is challenging. So just be mindful of that. And with any types of finance, I urge you to use a broker. So, you know, a lot of the time you just go to the bank and you're talking to a local manager or a local clerk or whoever it is, and they don't understand your business and the requirements of the business. If you go to a broker, they will know, a lot of the time, they will know how your business works and are working for you as opposed to working for the bank. You don't pay them, the bank will pay them. But just being, getting that advice from a broker and on how to structure finance and the various options around, as opposed to going to a bank, which is there purely to make profit. So just urge you, if you are looking at finance or needing it, is speak to a broker sooner rather than later. Don't go to him or her and say, I need finance tomorrow. Just get onto it early. Okay. What to think about with finance. So when you do need it, the few things that you need to think about. So how long are you going to borrow it for? Is it going to be a 1 year loan, 3 year loan, 5 year loan, 20 year loan? Think about that. Interest rates, we all know what interest rates, obviously the Reserve Bank cut them yesterday, so there's a bit of ease coming there. And what to borrow, it's stock standard. What do banks look at when deciding to lend you funds? There's three things there. So character, capacity, and collateral. Character is who you are, what your business does, historical side of things. So if you're going to try and borrow money from the bank, but you've defaulted on X amount of loans prior to that, you've got ATO debt up to the roof, the business is not cyclical, but it's volatile, they're going to question you more than someone who's got minimal debt, who has had no issues in the past, and is an A-class citizen, for lack of a better word. Sorry, I just realized I didn't check the chat box, so no questions there, so all good. Sorry. Capacity. So can you repay the debt? Do you have enough money coming in to enable the bank to collect their debt? Which they'll look at profit and loss forecasts, three-way forecasts, and so on, cash flow budgets. So if it's tight, they'll make you jump through hoops to get it. Okay, and that's purely to tick their boxes in terms of can you repay it. Okay, and then the last one is collateral. So what are you giving up to borrow that money? Easiest option or easiest way to explain it is borrowing for your home loan. The bank's taking security on your property, so that's fixed security. They've got a mortgage registered against the title of your property. So if you default, arguably they can take your house and sell your house and get their money back. So they're fixed security or fixed collateral, and floating as well. So floating is it's like they'll have a general charge over the business. So it's lodged with ASIC and basically they say that whatever money that the business does generate, they've got an option to receive that, basically. So where you've got less fixed security or no fixed security, the bank's probably going to compensate for that risk in terms of higher interest rates. So in other words, where you're less desirable on any of these three things, they will bump up the interest rate. Okay, or if you've got a less than desirable character, but you've got fixed security that's well and truly over the amount that you're borrowing, they'll be fine. And so they all work interchangeably, basically. Finally, just the last thing quickly. So again, very common question is, I need a new ute, CNC machine, excavator, whatever it is. I've got the money in the bank. Should I use cash or should I borrow to buy this asset? At the end of the day, cash is king. Everyone's different. Some people are very much against paying the bank interest, but cash is king. Interest may be that necessary evil to enable you to keep your cash flow going, and maybe the necessary evil to keep the cash coming in. So and a lot of the time you might have the cash now, but will it come back and bite you? So that's where the cash flow forecast is. If you've got the cash in the bank now and you've got your cash flow forecast set up and it's all green and blue sky, and it's going upwards, then yes, you may consider borrowing it. But if you've got the cash now and your cash flow forecast indicates that it's staggering or it's stalling, and it may be flat or going downwards, I would be very cautious with using cash. Okay, so I would probably say 90% of the times that I get that question, maybe 80%, we would be saying get credit. It depends what you're looking at and what you're buying, but a lot of the time, if it is a piece of gear, so a piece of plant equipment or something, it's the interest rates aren't huge, particularly over you borrowing at shorter terms. Excuse me. They're not massive interest rates, so again, it may be a cost to bear to give you that safety net, basically. And again, you might go, no, you can't go half and half, but if you're confident in your cash position, whether that's cash now or the cash flow ongoing, you may choose to borrow it over shorter terms. So instead of going and borrowing it over 5 years, you borrow it over 3 years, which just means that yes, the repayments are going to be that bit higher, but you've got the cash flow to support it, basically. Okay. That's all that I've got. So yeah, cash is a tricky one, and cash flow is a tricky one. It is, yeah, it's one of the more common problems in business. A lot of the time, people know how to run a business and do what they do, but they've got less cash knowledge and how to manage it, and less ability to manage it. So I think the biggest thing that I can say is just plan for it or plan around it. Excuse me. I reckon less than 20-30% of clients have cash flow budgets. The ones that do run close to the wind do have them, but I would urge you to do a cash flow budget and actually project it. If it's something as broad as doing it every month, that's fine. At least that way you can see when the big payments are coming through. So your BAS payments, for example. Whereas if things are tight, do it weekly. Yes, it needs a bit of time and a bit of admin, but I do think it's worth spending that to avoid the pain and stuff afterwards, basically. So I urge, if you do have cash flow difficulties, I urge you to look at a budget and a forecast. So, okay. Does anyone have any questions at all? I haven't had much come through or anything come through, I don't think. No, all good. So, no, that's fine. So yeah, hopefully that's given everyone a few insights in terms of yeah, what you can do. And yes, not all of it is purely around cash. There was some stuff in there about profit and the likes, but they're linked and they're related. So hopefully that's given you a few things, and yeah, hopefully it helps. So great, thanks very much for joining, guys, and yeah, hope you have a good day and good luck for 30 June. Okay, thank you. Bye.